Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about Restaurant Brands International stock. I will discuss their business, their future plans for 2022 and beyond, the dividend, the risk associated with this company, and finally I will provide a detailed stock analysis using my personal discounted cash flow model and then provide you with a fair value of this stock depending on your investment goals. The company HQ is located at Toronto and the shares are traded on TSX for almost 77 Canadian dollar at the time of recording this video. They pay a dividend with a starting yield of almost 3.57% and the market capitalization of the company is around 35 billion Canadian dollar. Restaurant Brands International stock price chart is kind of disappointing if you look at it in the past few years, as it was basically just fluctuating around $70 to $80 for the most part in the last 8 years, with a high of $105 and a low of $45 during the pandemic. And the stock price never really was able to grow consistently in the past. In this video, we want to see if their business model and business fundamentals can allow investors to enjoy a smooth capital appreciation and dividend growth in the coming years, or if we are going to see ups and downs in the business growth and a stagnation in the share price again. Before starting the video, I want to emphasize that I'm not a financial advisor. This video is not a financial advice for you to buy, hold, or sell this stock. This is just my personal opinion. You should always do your own research before making any financial decision. With that being said, let's start this video. Restaurant Brands International is one of the world's largest quick service restaurant companies with more than $35 billion in annual sales and over 29,000 restaurants in more than 100 countries around the world. The company operates as quick service restaurant chains in Canada, US, South America, Asia, and Europe with 4 brands under their umbrella: Tim Hortons, Burger King, Popeyes Louisiana Kitchen, and Firehouse Subs. Each brand under their umbrella operates relatively independently of each other and they have their own management, employees, and franchise relationships. So in that regard, Restaurant Brands International is like a holding company that owns these independent brands and their franchise relationships. The company initially acquired Burger Kings in 2010, then in 2014 they acquired Tim Hortons, in 2017 they acquired Popeyes, and recently they added Firehouse Subs to their portfolio. I personally love Popeyes and their stores are always packed, while I don't 100% like the quality of Tim Hortons or Burger King. Their stores are also always packed where I live, so before even looking at the numbers, I can say business itself is pretty good and they definitely have lots of room to improve their margins with automation and to expand their business internationally. As mentioned in the previous section of the video, Restaurant Brands International has different brands under their umbrella and each brand has a specific growth rate and expansion plans. For example, Tim Hortons has more than 3,900 stores only in Canada and it has #1 market share of the coffee serving in the country, higher than McDonald's and Starbucks. And they actually were able to slowly grow this market share in the last 3 years by 2 basis points, from 70% to 72%. They also plan to expand their business internationally into new markets like India in the next few years, which can allow them to continue to grow their total revenue. Without going into all the individual brands, the overall company revenue is slowly growing in the last few years, which is good, but the problem is the net income, the earning per share or EPS, and also their free cash flow is all over the place with lots of ups and downs, which is something investors don't like to see. Restaurant Brands International management clearly mentioned the reason for this increase in total revenue and also reduction in net income of the company in this quarter in the recent earnings report. So they mentioned the year-over-year increase in total revenue were primarily driven by increase in system-wide sales at Tim Hortons, Burger King, and Popeyes. On an as reported basis, the increase was also driven by inclusion of the Firehouse Subs. So a main reason that we see a jump in total revenue in the last year because they include basically the Firehouse Subs into the calculations. This increase in total revenue on as reported basis was partially offset by unfavorable forex movements, which means the currency conversion rate. Because US dollar was so strong in the recent quarters, the conversion rate of other currencies caused their international sales in US dollar to diminish. They also described the main reason for reduction in their net income. The year-over-year decrease in net income was primarily driven by income tax expense in the current year compared to an income tax benefit in the prior year. also unfavorable basically forex movements, and an increase in share-based compensations and non-cash incentive compensation expense, which is really not great. On the positive side, with an active investor like Bill Ackman as one of the major shareholders in this company, a lot of analysts expect them to be able to improve their margins in the next few years and eventually be able to consistently grow their net income and free cash flow. Restaurant Brands International has a long history of paying out and increasing its dividend year over year. In fact, they increased their dividend aggressively in the last 8 years from basically last 7 years from 44 cents to $2.78 per share, which is great. However, their payout ratio is not the best in the world, which is something to consider, especially if you also consider the relatively large amount of debts on their balance sheet. The 4 major risks with these investments are, in my opinion, 1. Possibility of slow growth or stagnation in business expansion in the next few years, which is something that Restaurant Brands International suffered from in the past. 2. Relatively large debt of the company. Right now they have almost 14 billion debt on their balance sheet, while their free cash flow is around 1.5 billion, which means it takes almost 9 years for the company to cover their debts with their free cash flow, which is not great. It's not the worst in the world, but it's not great. 3. Not so great profit margins, which is something they really need to work on in the future years. And 4, the impacts of the foreign currency exchange rate on their balance sheet, which is really high, considering they have a lot of international stores around the world and a lot of international exposure. This is my favorite part of the video, where I can show you my stock analysis based on the financial data I discussed in the previous parts of the video. I use a discounted cash flow model, which basically estimates the value of stocks based on the projections for the future cash flow. So I make some assumptions about the growth of the company in the next 10 years and then discount the future cash flows into the present value of the stock based on my expected rate of return. So I start with the past 4-quarter free cash flow of the company, and based on 3 different scenarios, I predict the future cash flow of the company in the next 10 years. In the bear case, or the most negative case for the stock, the company can grow their free cash flow by 6% in the short and mid-term, and then the growth will slow down to 4% in the long term. Again, I try to be conservative with Restaurant Brands International, as their cash flow in the bear case will have ups and downs. I consider terminal multiple of price to cash flow of 10 for this case, which is consistent with historical bear periods of this stock. For normal case, I consider a little bit better growth and a terminal multiple of 17, which is historical average multiple for this company. For the bull case, or the best possible outcome, I consider the business grows by 10% in the short and mid-term, and then it drops to 8% in the long term. And I consider the terminal multiple of 24, which is definitely a bull multiple for this company. Now, I assign a 50% chance to normal case, a 25% chance to the bull case, and 25% chance to the bear case. For growth stocks, I usually expect 15% return, and for dividend stable stocks, I expect a 10% return. If I expect a 10% return year over year from this company, the fair value of this stock is almost 67 Canadian dollar, which means compared to the current share price of almost $77, the shares are traded at 13% premium, which means it's not a buy according to the model. At this price, based on the model, you can expect to have a return close to 8% year over year in the next 10 years, which is not bad, but not enough for me. It's always fun to see what analyst predictions are for a company, and according to Yahoo Finance, the analyst price target for this company is currently at $97 per share for 2022 with a buy rating. It is a hold according to the research team, it is a sector outperformer according to Scotiabank analysts, Thomson Reuters has a neutral view on the company, and it is a hold according to CFRA. In summary, while Restaurant Brands International has great fast food restaurant brands under their umbrella, I think their brands are going to grow eventually. The possibility of a slow growth rate in the near future due to relatively large amount of debt on their balance sheet, and also inconsistent cash flow generation due to foreign basically exchange rates, acquisitions, and also share compensations are a real risk of investment in this company. I would personally not going to buy Restaurant Brands International at these levels, but would be interested in buying the stock if the stock price drops significantly in the future. I hope you enjoyed the video, and if you enjoyed the video, consider subscribing to the channel to see similar videos. Thank you for watching, and I see you in the next video. Farewell.